I'm joined today by Mr. Izak Odendaal, who is an investment strategist at Old Mutual Wealth. Izak is a regular contributor to our channel, writes a lot of articles that we publish on a weekly basis on EBNet, and we've also published several of them in Pensions World. Articles always very well received, and it's a joy to have you on the program today. Izak, good afternoon.
Thank you.
So give us a bit of a snapshot. I mean, it's been a very busy year so far. We're sitting just past midway in 2023. It's been a very, very interesting year, and I'm sure a lot still to come. So, a couple of issues happening. Obviously, global economy is under pressure. There's the war in Ukraine. There's the BRICS talks. There's a whole bunch of things coming and going, and I'd like to hear your perspective on where we're at and how the impacts are to be felt in South Africa.
Yeah, so I mean, there's always a lot to talk about. The thing is, what matters and what doesn't matter. And I think what matters from a financial markets point of view, and ultimately, as pension fund trustees, as fiduciaries of other people's savings and so on, things that we really care about is the bottom line. How is this going to affect the portfolio of our members? And if you just start and think about the beginning of the year, what were the expectations at the beginning of the year? I think two stand out. There were lots of expectations, of course, but two stand out. One is that you would see a marked slowdown in the US economic growth, the US still being the world's biggest economy and most important economy, and that you'd see an acceleration in Chinese growth as China comes out of those very strict lockdowns. And what's happened is pretty much the opposite. So you've seen in America, you've seen the continued resilience of economic growth there, despite all the interest rate increases over the last year or two. And, you're still seeing a very tight labor market, in other words, very low unemployment rate. You're seeing solid wage growth. You're seeing solid consumer spending. And really, as inflation is falling in America, of course, in real terms, all of those are picking up. So actually, halfway through the year, that sort of widely expected recession, widely flagged recession just shows no signs of arriving in America. Okay. In contrast, you've got China, where this kind of post-COVID boom has not materialized, and there are a number of reasons for that. I think one is maybe it just takes time. Just because the lockdowns are in today doesn't mean it's back to normal tomorrow. I think that was also the experience in South Africa. But the other issues, there's this conflict between the US and China in the background. I think that has impacted, for instance, a lot of US investment in China. It's impacted, how firms in China view future investment decisions and so on. But more particularly and more importantly, you've seen in China the property sector coming under severe pressure. And I think what we need to realize is that in that country, property is the main source of wealth. In South Africa, we've got a big, sophisticated pension system. That's kind of sits alongside residential property as being the main stores of wealth for ordinary South Africans. In China, it's pretty much all about property. And so as soon as you see a big wobble in the property sector, that has a huge impact on people's confidence. There's a lot of debt linked to the property sector, not just mortgage debt, but also the debt of the actual developers. When you have a lot of debt, prices are falling, people start panicking, right? Because the asset value that's linked to the debt is falling, the debt doesn't fall, the debt stays here, right? So that's always the fear when you in an environment of falling asset prices and falling prices in general, is that deflation is a killer when you've got high levels of debt. And that's the one thing China's got a lot of is debt. So yes, there's a cyclical moment in terms of coming out of COVID, and that will probably sort of ebb and flow. But there's also in the background the structural problem, which is that you've had a property boom, a property bubble for 20 years, and that's over, right? You're not going to see a repeat of this kind of massive surge in investment in property in China, and therefore they're going to have to find something else that drives economic growth over the next decade. It's not going to be the property sector. In fact, I think the property sector is going to leave a big gap in their growth numbers. So that's kind of the broad picture. So what you're seeing in terms of the policy response, obviously in China, the central banks cutting interest rates, but cutting interest rates doesn't help a huge amount. As I said, when people are really panicking, people are really losing confidence in property, the fact that it's a little bit cheaper to borrow now makes little difference when people are really fundamentally scared. In contrast, the US, they're still hiking interest rates. At least they were still hiking up until recently in the July meeting of the FOMC. Probably at the peak of interest rate hikes in America now. The rates have gone up very quickly from 0% to 5.5%. So big rapid jump in the space of only about 18, 19 months. And I think it's now time to stand back and let those interest rates kind of work through the system. And it takes time. I think everyone kind of maybe was too, thought that this would be a much quicker process. The fact, the impact of interest rates on the economy, but it takes time. And one of the reasons it takes time is, for instance, if people have long-term loans with fixed interest rates, then an increase in the rate doesn't actually have an immediate impact on your cash flow. So if you think about the typical American household, they've got fixed rate mortgages. So if you bought a house 2 years ago at a 3% mortgage, you're still paying 3%. Even though the new mortgage rate is 7%, you're still paying 3%. So that impact is not being felt now. It's only being felt on new people coming into the market, or people, for instance, who are forced to sell and buy a new house because, let's say, they move jobs or they get divorced or so on. Right. Similarly, businesses. Businesses have, in the past number of years, rather than taking out floating rate notes, loans, they've taken out fixed rate loans. So a lot of them have fixed interest rates, and it's only at the point of those loans kind of maturing and resetting that they're actually exposed to the higher interest rates. So I think it'll take time for these interest rates to filter through into the US economy, and therefore I don't think this resilience is necessarily going to last. But it certainly has lasted longer than people expected. And I think the flip side of the resilience is that as long as people have spending power, as long as incomes are strong, as long as there are plentiful jobs, people will spend, and that can maintain upward pressure on prices. So then it means that you're not necessarily winning the inflation battle from the point of view of the Federal Reserve. So yes, there's been big progress in terms of inflation. If you look at just the CPI measure, has gone from 8% down to 5%. So it's a big decline. But from 5%, it still needs to get down to 2%. And then it needs to stay at 2%. And I think there is not confidence on the part of the Fed that we on a path that'll take us all the way down to 2% and staying at 2%. Right. So therefore, I think, you're still looking at a higher for longer kind of interest rate environment in the US. And that is a big change from the world that we used to, right? The pre-COVID world was a world of low interest rates, of zero interest rates, of very low bond yields. And of course, that was a fantastic environment for the equity market. Because equities basically became the only game in town in kind of a US or global context. That picture's now changed, right? So there is more options in terms of fixed income. There's more options in terms of cash, in terms of bonds, in terms of corporate credit, and also thinking from the point of view of a South African investor, we used to just ignore global fixed income because why would you bother with anything that's giving you zero when you can get decent returns, fixed income returns locally? But I think that picture has now shifted. South African investors can now start looking at global fixed income a bit more closely, and certainly we have in our balanced funds, and just say, well, here's an opportunity that we didn't have 3 years ago, to earn a return, but also to diversify the portfolio away from equity exposure. Obviously, the equity market has done very well this year, right? So this kind of resilience in the US, and also, let's be honest, in Europe as well, although things are really slowing down in Europe quite a lot more. But yeah, this resilience that you've seen in the major economies outside of China have seen equity markets do quite well. I think at the end of July, the S&P 500 was up 20% year to date. That's quite a nice outcome. Of course, no one, that's a gift horse you don't want to look in the mouth. But I'm saying, let's be a bit cautious about future returns from this point forward from those equities, because that's been a sharp rally. really driven by investors becoming more excited about the prospects of a so-called soft landing. In other words, where inflation falls without causing damage to the economy. And yeah, my view is just that, yes, we can get a soft landing, but it's a possibility. It's not a given that we're going to get there. And I still think these high interest rates at some point are going to start putting the squeeze on the US economy, and therefore, be a bit more cautious on equities. And remember that the cost of being defensive has gone down. As interest rates go up, the cost of being defensive goes down. You're not missing out on as much if you're a bit defensive in a global portfolio. So how does all of that impact South Africa? Obviously, the number one area where it impacts South Africa is the currency. When you have a strong dollar, you have a weak rand. When US interest rates are rising relative to the rest of the world, you get a strong dollar. It puts lots of pressure on a country like South Africa, and we've seen quite a weak currency over the last year or so. But we've also scored a lot of own goals in South Africa. It is, by the way, if I can, as an aside, it is the Women's World Cup at the moment, and South Africa is actually playing really well. And we've just won our game against Italy, and we've actually scored real goals, proper goals. But as a country, we're in the habit of scoring own goals. If you think about load shedding, if you think about our foreign policy choices, this perception that we're very friendly with Russia while this war is still going on, so that's all added pressure on the currency. And I think one of the interesting things this year has been just how the rand has been weaker while other emerging markets currencies have been strengthening. Right. So if you compare South Africa with Brazil, their currency has actually been strengthening this year. The rand has been really quite weak and quite choppy. So that's the main area. That's the main kind of channel through which we experience global issues. But obviously, our bonds and equity markets don't ignore what happens globally. So our equity market has also tended to follow global equities. So we've had a decent return so far. Despite the load shedding, despite all the negativity, despite the fact that the economy is performing much weaker than we expected at the beginning of the year. And that really is because load shedding has been much worse than we expected at the beginning of the year. And it's also because, interest rates are much higher today than we thought at the beginning of the year. And bearing in mind that unlike in the US, where there's a lot of fixed rate loans, in South Africa, most loans are variable, right? So if you take out a mortgage, as soon as the Reserve Bank raises the repo rate, your monthly payment goes up. So we feel the pain much quicker in South Africa, and therefore I think the repo rate changes tends to slow the economy, has a much more immediate impact on the economy than, for instance, in the case of the US. The good news is, in South Africa, I think the Reserve Bank hiking cycle is done. We've seen inflation peak, also peak at around 7%, just above 7% is now below 5%. So it does look like inflation is going to continue falling, notwithstanding the fact that the oil price is a bit higher over the last week or so, and the grain price has obviously also jumped following Russia pulling out of this Black Sea grain deal. Nonetheless, both oil and food prices are much lower than they were a year ago. So when we're talking about inflation, we're talking about the change from a year ago to today. And in both instances, we're still in negative inflation. So we should continue to see the overall CPI number trend, from 5% and sort of move around these levels until eventually moving down towards about 4.5%. So I think that's fine. I think that's within the Reserve Bank's target band. That's kind of where they want inflation to be. No need for them to raise interest rates further unless something badly goes wrong, which touch wood, it doesn't. So I think the worst is over in terms of that kind of combined inflation interest rate shock for South African consumers. In terms of load shedding, of course, it continues to be a hassle, but I think what we're seeing is, number one, companies becoming used to it. We all do. We all become used to living with load shedding. We adapt to load shedding. We are adaptable people. And number two, we're seeing lots of investment into alternative sources of electricity. And Eskom came out with a statistic a day or two ago, and they said that the installed capacity of rooftop solar or any kind of solar, rooftop and non-rooftop, has quadrupled over the last year.
Wow.
And is now in the region of 4,500 megawatts, which is more or less the size of a big power station,
right.
A Medupi kind of power station, if Medupi were up and running at full capacity, which unfortunately is not.
Yeah.
So basically all these kind of private entities, households, small businesses, big businesses together have, in the space of a year, constructed the equivalent of a massive power station. And I think that is quite an achievement. And I think you're going to see more of that. And I think slowly we're kind of getting on top of this load shedding problem, not because Eskom is performing a lot better, although I think it does look like things are stabilizing there, but just because the private sector is stepping in and can solve their own problem, thanks to regulatory changes. What we need now as a country is to kind of see the same thing happening in other sectors. We need to see the same thing happening in rail, in ports, and some of these other problem areas in the country. There's a lot of appetite for the private sector to get involved. There's a lot of appetite for pension funds to invest in these kind of infrastructure projects. So I think that is quite an exciting story over the next couple of years. It's going to take time. It's not a 6-month story or a 12-month story. This is a 3-5 year story. But I think it is a reason to be optimistic about more optimistic about the future of this country than I think most people are today. You and I both know that we've got extremely high levels of pessimism. Confidence is low. Investors want to take their money offshore. That's the world we're dealing with. But it also means that kind of pessimism is already reflected in South African asset prices. So if you look at our bonds, you look at our equities, look at the currency, it is really discounting a lot of bad news already. So it's not as if the market is kind of ignoring the daily reality that South Africans face.
Izak, thank you very much. Very insightful, and it'll be interesting to watch this space going forward. So thank you very much. Really great insights, and look forward to chatting to you again. Thank you.